Hello again, everybody. Welcome back to Accounting 1101, where we are in a unit on fixed assets. In our previous video, we went through and talked about Kings Island, walking around the park, looking for fixed assets. And we said roller coasters, that meets our definition of fixed assets. The buildings that they have on property there at Kings Island, they also meet our definition of a fixed asset. So what exactly is that definition? We said a fixed asset is a relatively permanent asset, such as equipment, machinery, buildings, land, and if you're Kings Island, a roller coaster. And the idea here is we have, a big piece of equipment. We're going to use it for multiple years or multiple accounting periods, and we're going to treat it as a fixed asset. So today, now that we have that definition nailed down, our video today, we're going to talk about what do we include in the cost of a fixed asset when we construct that roller coaster, when we buy that building, when we buy that equipment. What do we include in that cost? And if we look at the balance sheet for Cedar Fair, the parent company of Kings Island, again, we can see all the different categories of property and equipment and all the related balances that are included. And again, these numbers here are in thousands. So when you see 443,000, that's really 443 million. You're putting 3 zeros behind it. So all of these numbers that you're looking at right here, that is the historical cost. That is what Cedar Fair paid to buy the land, to build the building, to make the roller coaster, to buy the cash register, to get the computers, whatever happens to be in that category. And then you'll notice right below that, less accumulated depreciation. We'll get to that part a little bit later. But on their balance sheet, they're recording the historical cost of what they paid and then subtracting out what they've depreciated to get a net amount of property, plant, and equipment. So our goal right now is just to figure out what goes in that number for historical cost, for land, buildings, equipment, and so on. We'll worry about the depreciation part later on. Our general rule: the cost of a fixed asset includes all that is spent to do two things. One, get the asset in place. And number two, get the asset ready to be used. So your general rule, all the money that is spent to get it in place, and get it ready to use, we're going to include that in our fixed asset number. And so to give you an idea of all the things that could include, let's just look at the building part here. If we're talking about a building, what do we have to spend to get it and get it ready to be used? If you look, that could include architect fees, engineering fees, insurance costs that we had during construction, interest on the money that we borrowed to finance the construction, any repairs if we bought an existing building and we had to make repairs to get it ready to be used, modifying the building so we can use it, and any kind of permit that we had to get from a government agency. All that money would go into buildings, and we would record it as part of the historical cost of our building. Machinery and equipment, any sales taxes we paid, any shipping or freight, installations, insurance while we were having it shipped to us, any assembly, any testing that we had to put it through before we could use it, any kind of permits that we had to buy to be able to use it, all that would go into our historical cost of machinery and equipment, or roller coasters in the case of Cedar Fair, equipment and roller coasters there. Land and land improvement, purchase price, sales tax, permits, title fees, surveying fees, any delinquent real estate taxes we had to pay from the previous owner before we could get possession of it. Grading, leveling. Again, we're talking about things we have to do to get the asset ready to be used for our purposes. And so keep that general rule in mind. All the money that is spent obtaining the asset, getting it ready for use, is going to go into that number on the balance sheet, the historical cost. So what is not included in the cost of a fixed asset? Our general rule here: any unnecessary costs that do not increase the asset's usefulness. We're going to record those as an expense. We're not going to put them on the balance sheet. And so some examples of that might be vandalism. Maybe we had some vandalism issues as it was getting set up, or after we got it set up and we had to repair that. That's an unnecessary cost. It did not increase our asset's usefulness. Mistakes that were made during installation that caused extra cost to be fixed. We wouldn't include that in the cost of a fixed asset. Any damage that occurred during unpacking and installation that was not insured, we wouldn't include that. And any uninsured theft or damage, we wouldn't include those costs as part of the fixed asset. We would expense those as repairs and maintenance expense, or maybe miscellaneous expense. So let's go back to Diamondback. Again, my favorite ride at Kings Island. Love me some Diamondback here. It took Kings Island $22 million to get that asset built and to get it ready to be used. You can see right there, it opened in 2009, $22 million. It was our cost of construction there. So we can find that number here in property and equipment in rides and equipment. Somewhere in that $1.9 billion amount is $22 million for Diamondback. So what happens after we've got it recorded? We've got the historical cost, we've put it on the balance sheet. Well, then it's depreciation time. I stole the note here from the notes to the financial statement for Cedar Fair. And as you can see, it says property and equipment are recorded at cost. Hey, guess what? We knew that, right? Depreciation is computed on a straight line basis over the estimated useful life. And you can see the estimated useful life is 20 years on a roller coaster at Cedar Fair. That's the estimated lifespan. So our goal, where we're going now, in our next two videos, we'll talk about how to calculate that depreciation. When we depreciate an asset, we're spreading the cost of that fixed asset over the asset's useful life. We're taking that $22 million we paid for Diamondback, and we're spreading it over 20 years. That's all depreciation is. Taking the amount of the fixed asset, spreading it over the life of the asset. And that confuses some people. Because, people think, well, depreciation, I buy a new car, I drive it off the lot, and it depreciates 40% the second I drive it off the lot. And yeah, okay, that might be true, but that's not what we're talking about in accounting. In accounting, depreciation is simply taking the cost of what we have, the fixed asset, and spreading it over the years we plan on using it, the estimated useful life. It's an adjusting entry that we make at the end of every period. For depreciation. Doesn't involve any cash at all. And what we're doing is we're trying to match up the cost of that asset to the revenues that it's going to generate. And we expect Diamondback to pull people in for 20 years and be an attraction for 20 years. So we want to spread the cost of that and match it up with the revenues that Diamondback is going to generate by pulling people to the park. What depreciation isn't. It's not a reflection of the market value of the asset. And I can't say that enough. Depreciation has nothing to do with market value. Okay? The market value of that roller coaster may be a lot more or a lot less. Who knows? It has nothing to do with it. In accounting, when we depreciate, all we're doing is spreading out the cost. We're not trying to measure how valuable something is according to the market. It's also not a sinking fund for replacement of an asset. It's not like we're putting cash away every time we make that entry so we can replace that asset later on down the road. Depreciation has nothing to do with cash. When we make that entry, it doesn't involve a dollar amount of cash, right? We're just making a little bookkeeping adjustment. It's also something that we do not do to land. Okay, we don't depreciate land. We depreciate equipment. We depreciate roller coasters and buildings, land improvements, but we don't depreciate land itself. So where are we going from now? We got the idea down about the definition of a fixed asset, calculating the cost of a fixed asset. Now we're going to actually do a little math here and calculate depreciation. I'm going to show you two separate ways to do that. In our follow-up videos, we'll talk about a partial year depreciation, and we'll also talk about how to dispose of a fixed asset. And so a lot to cover in our unit on fixed assets. We hope to see you back here for each one of those videos. Take care, everybody.